Welcome, everyone, and thank you for joining us today. My name is Nadim Hirji, and I'm the head of Canadian Commercial Banking for Bank of Montreal. And I'm joined by my colleague, Douglas Porter, BMO's chief economist, and what I coin him as the crystal ball fortune teller. We're honored to be invited back here again at the Ignite conference to share some insights about what may lie ahead. Now, we'll start our session today with Doug's economic update, and then we'll follow that with some questions that we often hear from many of our commercial banking clients. So let's get started. Doug, you've got the floor.
Okay, great. Thank you, Nadim, and welcome everyone. It's a pleasure to join you here today. What I plan on doing is basically laying out where we see the economy going over the next 20 or 30 minutes, and then, as Nadim indicated, we'll then do an interactive Q&A period. So, from a very big picture, it's very interesting to me how the major economic focus has shifted away from the pandemic and more to supply chain issues this year. Now, that's not to say that the pandemic has completely gone away. In recent days and weeks, we've actually seen an upswing in cases across much of the advanced world, especially in Europe. They're actually seeing as many new cases as at almost any other point during the pandemic. But we're also starting to see a little bit of a comeback in the US and Canada. Now, importantly, certainly in North America, we're not at the same time seeing a big run up in hospitalizations. And of course, that's largely due to a fairly significant rollout of the vaccine in almost all major economies. Notably, Germany and the US are a little bit lower than others on the vaccination rollout. But I think the key point here is that when we look at the economic outlook into 2022, the pandemic and COVID will still be an issue. It will still, we think, somewhat restrain the recovery, but we don't believe it will be the dominant economic story. We think that that will continue to be the supply chain issues. And just as a very big view in terms of the supply chain issues, um, one way to think about it is it really is mostly due to just a wave of demand that we're seeing globally. You hear many things about supply bottlenecks and kinks in the supply chain, but frankly, what's happening here is we're just being hit with a tidal wave of demand for goods that is just straining the supply chain. By many measures, supply is actually operating at an all-time high. For instance, to give you about one example, there are as many container ships on the ocean as ever right now. US manufacturing production is about as high as it's ever been. It certainly is in China. So it's really more of an issue of just overwhelming demand swamping the supply system. Now, it's interesting when we look at financial markets, despite these two big threats or drags on the economy, we're still seeing financial markets basically looking ahead to still very strong growth. In recent days, we've seen the equity market hit all-time highs globally, and in the past year, broadly, stock markets are up by about 30% in the past year, a very strong performance. But it's not just the stock market. Another market I often look to as a good leading economic indicator is the corporate debt market. What are corporations paying to borrow money versus governments? And what we saw is that during the depths of the pandemic, that spread for what corporations paid jumped very temporarily, but then it came back down and it's now been quite stable in recent weeks and quarters. And it's actually below where it was before the pandemic began. So that's a relatively encouraging economic signal. And maybe even most notably is commodity prices still remain very, very strong. They carved out a perfect V-shaped recovery last year. And on top of that, they've risen by another 50 to 60%. And that is simply unbelievable after the deepest downturn in the global economy that we've seen in the post-war era, to be talking about commodity prices up 60% from their pre-pandemic levels. So the main message from financial markets is relatively strong growth lies ahead. So with that, let's look at what we're looking for first of all, the global economy. And 2021 actually turned out to be a pretty strong year after a tough 2020. But frankly, the global economy didn't quite live up to the most optimistic expectations we had for it. We still think it's going to grow by about 6% this year, which is one of the strongest years we've seen in decades. But of course, that followed that devastating 3% drop last year. And growth of just a little bit below 6% wasn't quite what many, including us, had hoped for. And there's no mystery what happened. Basically, it was those supply bottlenecks and the Delta variant, that really did throw a little bit of sand in the gears and cool the global economy. Now, the good news, as I said, is financial markets are looking forward to another strong year next year. And some of the slowdown we saw this year, we think will just represent pent up demand for next year. So we're still looking at a pretty strong year of growth again in 2022 when we think the global economy will grow by about 4.5%. And even out into 2023, we're still looking at somewhat above average growth globally. Just to put all those numbers into perspective in the lower right hand quadrant, a normal year, a quote, so called normal year for the global economy would be growth of about 3%. So each of this year, next, and the year after, we're looking at above average growth until we finally get back to something close to normal when we get out into 2024. Now, let's drill down to what does this mean for North America? And in many respects, what we saw in Canada and the US is very similar to what we saw in the global economy. Essentially, a nice, strong rebound from a tough 2020, but again, not quite living up to the most optimistic expectations we had for the North American economy. So, for instance, at one point, we thought the US economy might be able to grow by 7% this year. Instead, it now looks more like 5.5% growth. That's still a very strong year. The other thing to point out is US growth or activity is basically back slightly above where it was before the pandemic began. That's a remarkably quick recovery in the US. Now, it hasn't totally made up all the lost ground on per capita terms. There's still some wood to chop here. There's still some way to go. So that's why we've still got a somewhat above average growth in the US next year. But in Canada, we think there's even more ground to be made up. We went through a deeper downturn during the pandemic. We've had a somewhat slower recovery because we faced more restrictions than the US economy. We've had more lockdowns or longer lasting lockdowns. So I would argue there's actually a lot more ground to make up here in Canada. So we think the Canadian economy will actually grow faster than the US next year. Another solid year in Canada. When we look back on 2021, there's really three main reasons in Canada why things didn't quite live up to potential. Two I've mentioned, the spread of Delta and supply chain issues, which really hit the auto industry in particular. But the third one that I haven't really talked about is a very severe drought in Western Canada. Now, when we look out into next year, we think all three of these will show some improvement, paving the way for pretty solid growth. So, in other words, we think the supply chain issues will fade somewhat. We're hoping that the drought won't be quite as intense next year. And as I said at the outset, we think COVID will not be a dominant economic story next year. It'll still be around, somewhat slowing the recovery. But when we put all those strands together, we're looking at a pretty solid year for the Canadian economy, outpacing the US in 2022. Now, in terms of the job market, much like the economy overall, we've seen quite an improvement in both Canada and the U.S., but there's still a bit of room to go there. In both countries, the jobless rate is still about a percentage point above where it was before the pandemic began. So there's still some work to do. Interestingly, Canadian employment is actually now higher than it was before the pandemic, but of course we've had population growth, so it would still take about another 250 or to 300,000 jobs to get us back to full health on the job market front. Even more room to go in the U.S. Um, the U.S. is still missing 4 million jobs, so it's still got a little bit of way to go before they're fully back to health. Now, you may remember just a few moments ago, I said that U.S. output has completely reversed the damage in the pandemic, and yet their job market arguably is further away from full health. So what's going on? How can we, fit all these different pieces together? Well, looking back over the last 18 months, what I would say is that Americans have been more willing and able to get back out than their Canadian counterparts, but been willing and able to get back to work. They felt safer going back to work because we have had tighter health restrictions here. And so, on the surface, it looks like things are fairly similar between Canada and the US. But beneath that calm surface, there's actually a lot of pretty important differences going on between the two economies. Now, let's turn to probably what's the biggest issue right now for financial markets, and certainly one of the questions we get asked the most, and maybe the biggest uncertainty facing the economy over the next year, and that's what's going to happen to inflation. And just as a brief recap, we went from basically, standing still on inflation at the start of the year in both Canada and the US to now where headline inflation in the US is running at 6% and it's running at almost 5% in Canada. We don't think we've quite hit the peak yet. We think in the next couple months it could go a little bit higher yet in both economies before it then begins to fade a little bit in 2020. But a couple points I would like to leave you with here is even by the end of next year, even when inflation does come down, we still see inflation above pre-pandemic levels in both Canada and the US by the end of 2022. And also, when we look at what we think price gains will average next year, we're looking at about a 3.5% average inflation rate in Canada and about a 4.5% average inflation rate in the US next year. Now that probably doesn't sound that scary when we've got 6% inflation right now in the US. 4.5% actually sounds pretty good. But just to put some of those numbers into perspective, we have not seen inflation average more than 3% for a full calendar year in Canada since 1991. 30 years ago. So these inflation rates are really something we haven't seen in quite some time. And to me, the big issue or the big risk is, could we be surprised again in the next year? Is this an issue that's going to linger for longer? And let's look at a couple factor on that front, answer that question. First of all, let's dig in what's gone up in price a lot in the last 12 months and what this table looks like on the right-hand side is it looks at the things that have gone up the most in the past 12 months. And, it's a lot of exactly what you would expect on the right-hand side. Energy prices, gasoline and natural gas. And then, the things that have reopened from very, very weak activity a year ago, like hotel rates and airfares. But as we move down that list, there are things that are a little bit more concerning that could last a little bit longer. Things like home prices, meat prices. We're seeing a lot of food prices going up, but meat is really leading the way. And then furniture and cars and appliances, things that usually do not show much inflation. At least they haven't for decades. And so when we look at all these things, we still think that there's some potential for this inflation episode to be a little bit stickier than many people expect. Now, on the left-hand side, I've also listed some things that have actually dropped in price over the last 12 months. And, the main point here is not everything is going up rapidly. And there's some pretty important things on the left-hand side, things like telephone services, auto insurance, fresh fruit and vegetables have actually come down in price. So I guess the main message I want to leave you with there is not everything is rising rapidly in price. Now, certainly one thing I am keeping an eye on, though, first of all, is wages to see whether wages actually begin to now respond. And that's what could make this a little bit more lasting episode. The other thing I'm watching very closely is the housing market. And this is one area where we still think the balance favors sellers and that we could still see some further upward pressure on prices. And this will slowly but surely continue to feed into underlying inflation over the next year. And by the way, it's a very similar story in the US. Average home prices in the US have also gone up by about 20% in the past year. Now, when we look at across it nationally, almost every major city in the country has seen pretty strong price gains in the past year. And as I said, unless there's some really serious policy medicine, I still believe that the underlying risk is that home prices continue to rise and add to inflation over the next year. Now, what can bring down home prices or at least calm them? Well, the most obvious candidate is higher interest rates. And that does look like it might be on deck for 2022. And this is one area where the sentiment or the view has really shifted importantly in recent months, largely because of those high side surprises that we've seen in inflation. Just recently, the Bank of Canada governor, Mr. Tiff Macklem, suggested that the time at which they think interest rates will need to rise has been pulled forward. They're now suggesting that interest rates could rise start to rise, I should say, anywhere between next April and September. And I would suggest that if they're even talking about the possibility of rates going up as soon as April, I think there's a very good possibility that they could rise as early as April. Now, we've been thinking that the first rate hike would be around the middle part of 2022, and then the Bank of Canada would raise rates by 0.25% per calendar quarter until they got back to where they were before the pandemic, which is about a 1.5 percentage points above where we are today. Usually, when I talk about an interest rate forecast, I say if we're going to be wrong or surprised, it's that rates will be a little bit lower than what we're forecasting. Not this time. I think the risks to our forecasts are that the Bank of Canada goes earlier, they raise rates faster, and they ultimately lift them higher than where they were before the pandemic began. And I certainly think that will be the case if we do begin to see things like wage pressures add on and if inflation doesn't begin to moderate in 2022. Very similar story for the US central bank. Just recently, we've had the Fed chairman reappointed for another 4-year term that knocks away one hurdle of uncertainty on U.S. interest rate policy. Quite simply, we think the Fed will not be that far behind the Bank of Canada. As we speak, the markets are pricing in 3 rate increases by the Federal Reserve next year. We think that's very doable, and we think ultimately by 2023, U.S. interest rates also will be back to where they were before the pandemic began, and that goes for longer term interest rates as well, which is on the right hand part of this chart. Last couple topics I'll touch on just very briefly before we bring Nadeem back in. One is on fiscal policy or the government budget deficit. Almost since the pandemic began, one of the most common questions I was getting was, how are we going to pay for all these special programs and this big run up in the budget deficit? Well, I long suggested that an economic recovery was going to do most of the hard work. And sure enough, that's what we're seeing happening. Budget deficits across the country and even for Ottawa are starting to come down pretty aggressively now. However, during the election campaign, we saw a lot of very generous proposals on spending, and of course, we've still got a minority government. The Liberals, the ruling Liberals, do need a partner to get legislation through. And I suspect that they're probably going to have to spend even more on many items than what they were initially projecting. So, the improvement in the budget deficit will probably be a little bit slower from here on out. And I think ultimately, what the government is targeting is to stabilize the debt to GDP ratio at 50% of GDP. That's a big step up from the pandemic days, but it's still well below where we were back in the 1990s. Now, another question I've been asked a lot about is tax increases. I would simply say I think that's more of a political issue than an economic issue. Because frankly, if we just let the recovery go and run, we would probably see the budget deficits get back down close to where they were before the pandemic began, because revenues have consistently come in very, very strong in the last year or so. Final topic I'll touch on very briefly is just the Canadian dollar. Much like almost every other financial market variable, the Canadian dollar went through a quick V-shaped recovery during the pandemic, and then it's built on that improvement in the last 6 months or so. When we look ahead, there are many mixed messages for the Canadian dollar, but overall, we think the Canadian dollar is more likely to strengthen rather than weaken, at least over the next year. We still believe it has a lot of very positive tailwinds behind it. First of all, we do think the Bank of Canada will be raising interest rates before the Federal Reserve. Commodity prices remain very favorable for the Canadian dollar. And finally, in a world that is seeing further economic recovery, strong recovery, that tends to be a positive for the Canadian dollar. Now, longer term, I'm a little less optimistic on the Canadian dollar. If we look out, say, 3 to 5 years, I would expect the Canadian dollar to drift back down to sort of the 75 to 78 cent range is what I would regard as long run fair value for the currency. So just to wrap it up and to tie it all up in a bow, overall we do still believe that even though the recovery didn't quite live up to the most optimistic expectations, we still look for relatively above average growth next year in Canada and the U.S. as we continue the reopening trade and as COVID slowly but surely fades as an economic story. Still, the two big risks, no question, for the economic outlook are still, COVID, of course, and just how long does it take for these supply issues to reverse? The other big threat out there, the other big uncertainty, is the inflation outlook. Versus other forecasters, we do tend to warn a little bit about the upside risks here. We think this could become a little bit more of a longer lasting episode of inflation, but I would stress that I would not throw around the word stagflation. Stagflation was a period when we had double digit inflation and double digit unemployment back in the late 70s and early 80s, and we simply don't believe we're reverting to that very unhappy episode that the global economy went through many, many decades ago. Finally, for financial markets, and I think the most important message is we do believe interest rates are going up next year. We think the first rate hikes could come as early as April, but generally speaking, we think that it's almost certain that rates will be rising by the middle part of next year. And then we think we're going to see a pretty steady grind up from that point. For the Canadian dollar, because the Bank of Canada is leading, we think that's relatively positive. And overall, we are still constructive on the equity market in this environment, as we do expect inflation to fade somewhat next year. And as I mentioned, still a relatively robust global economic backdrop. So that's it for the formal part of the presentation. I would now like to invite Nadim back in to help me with the Q&A period. Thank you very much.
Okay. As always, thank you, Doug. Your presentation, as always, is insightful. So that was a great setup, I think, for our Q&A. So I think we'll go right into that. And Doug, these are questions that have been sort of compiled based on a lot of questions that our commercial bankers are getting from our clients today. Some of this I know you covered a little bit in your presentation, but I think there's a few nuances to the questions that maybe you can provide everybody who's listening a bit more detail into. So firstly, let's talk about the supply chain. And I think you started your presentation talking about supply chain and the issues that everybody is seeing. It's interesting though how you're looking at it as this is not just a supply chain issue, but this is as much a demand issue. So I think of my personal situation. I ordered a car, Doug, 9 months ago. 9 months ago, and I'm still waiting for it. Every month I think I'm going to get it. I got a call saying it's going to be one more month. So it seems to be never ending. So I've got really two questions for you, Doug. First, can you predict when I'm going to get my car? But more seriously, do you see any supply chain relief in sight? And what are your thoughts as to whether the supply chain or demand side issues, whichever way you look at it, how does that affect the long term growth for Canada?
Yeah, an excellent set of questions, and frankly, I don't dare make a promise on when you're getting your car, Nadeem. It's interesting. The auto sector has actually been the poster child for the supply chain issues, and frankly, that largely goes back to the chip shortage that we're seeing. And just as a quick recap, there were some constraints on chip output, but a lot of it was just the insatiable demand for all kinds of electronics products that we saw globally. That's still running strong as we speak, and it just overwhelmed the existing supplies that we've had. And it's just incredible how many chips, for instance, go into a typical automobile in this day and age. It's interesting. I listened to what GM and Ford have to say on this issue and other automakers very closely, and it's fascinating to me how the timeline keeps getting pushed out. As I understand it, we may be past the worst. That's the good news, but the bad news is it is going to linger as an issue through next year. We're still not going to be back to full production, even through next year, I believe. Now, the second part of your question was, how does this affect the medium term growth outlook? And I actually, on that front, I'm a little bit more optimistic because you talk to people in the auto industry, and what they're looking at is we've got a lot of pent up demand here, like a lot of ground to make up. When those chips, as those chips become available, we're looking at possible boom-like conditions at some point down the line in terms of production and sales. The weakness that we've seen in the auto sector has got nothing to do with demand. It's all a supply story this year, and I would stress that's only in the auto sector. Um, so basically, we've got all this pent-up demand for autos that will still be with us for a number of years. So it's almost like some of that growth will be fed in for a number of years in the sector. So I'd be looking at relatively strong conditions in the auto sector for a number of years as they play catch up. With all this pent up demand that we've built up over well, really the last couple of years now. In terms of the broader supply issues, yeah, it's going to be a process. I don't think there's going to be like suddenly a light bulb moment where we say, oh, it's all in the rear view mirror. I think it's going to slowly but surely improve over the course of 2022 and possibly even in early 2023. But as I understand it, arguably we might even be past the worst of the supply chain issues even as we speak. It's going to be a long recovery and workout from those issues.
Okay, thanks, Doug. So no car as a Christmas present for me this year. So that's good to know.
Doesn't look like it.
No. So hand in hand with supply chain issues, the other thing that our commercial clients talk a lot about is the labor issues they're facing, and primarily is labor shortages. Now, when I speak to clients, there seems to be a bit of a consensus that a part of the issue are the government wage subsidies that are still being paid. Now, I know the amounts have come down and they're being sort of tapered off, but there's a sense out there that these government programs are helping prevent some of the labor coming back into the workforce while they can still get some of the government subsidy. But it's interesting during your presentation, if I heard you correctly, you said that we are at better employment rates today than we were pre-pandemic, if I heard you correctly. So I'm trying to reconcile the fact that we have better employment rates and less unemployment rates today. Um, we've had many businesses that have shut down that we know of and have created labor force availability. But yet, so many of our clients, in fact, if not all of them, tell us that they have labor shortages. And so I'm trying to reconcile how this is all happening. So can you maybe just help us understand this a bit better? And if you and your view on if you think that there's an impact here with the government wage subsidies on this.
Yeah, and excellent question. I would fully agree that this is one of the bigger issues we're facing right now. And by the way, just to step back for a moment, if you think we have labor shortages in Canada, well, raise it to the power of two in the U.S. It's actually much more serious in the U.S. Right now, there are more than 10 million job vacancies, and there are quote only 7 million people counted as unemployed. That's extremely unusual to have more vacant jobs than there are people unemployed. We're not quite at those kind of levels in Canada. We've got a lot of job vacancies in Canada. The last count is almost done. But that's actually more than that's not as many as there are people unemployed. So we don't have quite as tight a market in Canada. Now, going back to your issue on whether this is being driven by some of the subsidies or generous unemployment insurance schemes in both Canada and the U.S., I do think it played a role in dissuading people from coming back to the labor force. But it's important to point out that in both Canada and the US, the most generous programs have really been wound down. And some of this is very recent. For instance, in Canada, they really only ended in late October. So it'll be very interesting in the next couple months to see if we get a shift, in the number of job vacancies and the number of people in the labor force. And to be clear, the unemployment rate is still higher in Canada and the US than it was before the pandemic. But there's more people employed in Canada now than there were before the pandemic. The reason why the unemployment rate has still gone up is because we've had population growth since then. So we'd still need about another 300,000 jobs to get us back to full health. What's also keeping people away from the labor force? Well, frankly, they've built up a lot of savings in the last 2 years. Some people have been able to retire early too because, of how much their homes have gone up in price, or if they're investors, their stock portfolios have gone up in the past year. Household wealth has, gone up quite solidly on average through the pandemic, and that was really one unintended consequence of all the government programs and the heavy duty monetary stimulus that we saw, is that households are actually in better financial shape now than they were before the pandemic. So that too has allowed people to retire than earlier than normal, and that's especially the case again in the U.S. more so than in Canada. Now, a question to me is, how long lasting are a lot of these changes? Like, are these all going to be permanent changes, or will some of these factors slowly fade in the years ahead? And I'm always reluctant to assume that some of the changes we've seen during this very unusual episode will be permanent. I tend to believe that a lot of these folks who have left the labor force might be tempted back in the years ahead. Either as their financial cushion winds down, or they realize the government payment just aren't that generous, or they're not worried about COVID anymore, or they don't have childcare responsibilities that they have to look after, or caregiver responsibilities. And so I suspect, when we get out a couple of years from now, the labor force will actually revert to something close to more like normal. I think longer term.
Okay, all right, that's helpful. Thank you, Doug. Let's turn to the real estate market again. Something you did talk briefly about in your presentation, and you said, one thing that will likely impact the growth in the real estate market is interest rates. Um, but can you speak to more of the longer term impacts you think on real estate from what we've seen in the pandemic? I know at the beginning, at the onset of the pandemic, I remember, for us, one of the areas, besides the, entertainment and restaurant and hospitality sector was the real estate sector. There was a notion that, what's going to happen to condos and all the pre-sales? Will they actually close on the pre-sales? Our market's going to come down. Um, and everything, as you know, Doug, went to the exact opposite, right? I mean, um, construction kept continuing on, and it was even stronger than before. Pre-sales were not an issue, and we had lots of price acceleration, as you know. So, do you see a? I mean, I get the interest rate part, but once we get through the pandemic, do you see a reversal of some of the trends that we saw during the pandemic in real estate?
I think the answer is yes. I'm not convinced it's going to be a 100% reversal, but I suspect we will see many of the pre-pandemic trends and levels reassert themselves, and to some extent we're already seeing it. We saw it in 2021. During 2020, by far and away the biggest demand was for big houses out in the suburbs or even further out in rural areas, and we actually saw condo prices falling for a while. Well, where has some of the strongest sales activity and price activity been this year? Well, in the condo sector. It really has come back in a big way. It hasn't come all the way back, and I would actually suggest there's still some room on that front. And keep in mind this all happened at a time when immigration levels got really cut down. The heavy flow became a trickle for a time, and we've actually had one of the weakest gains in population growth in many decades in the last year in Canada. And of course, the federal government remains heavily committed to their medium-term immigration targets. When immigration gets back close to something like normal, maybe even a bit above normal for a spell, I think that'll be highly positive, certainly for the multi-unit area. Um, one area I am a bit cautious on is some of the areas that really boomed, and the absolutely ferocious price gains we saw were in some smaller and medium-sized cities outside of the big cities. Especially in southern Ontario, almost every medium-sized city or smaller saw price gains of 30, 40, 50%. I frankly just wonder whether those some of those gains are sustainable, especially when interest rates do begin to rise and things get back to something close to normal. Um, like activity in places like, London, Ontario, or Chatham, or Sarnia, or Windsor, they it just doesn't support the kind of price gains we've seen. Now, if some of it was driven by retirees moving to those more affordable regions, some of it was driven by investor demand, though. And I have to wonder if some of those cities aren't the most vulnerable when interest rates start backing up and maybe the investor class takes a little bit of a step back. Now, I'm not in the bubble camp. To me, if you call this a bubble, that suggests that everything we saw on the way up will then be reversed on the way down. And I simply don't believe that we're going to have a full reversal on the way down. But a correction of say 5 to 15% in some of these high flying cities is certainly doable. The other thing I would stress is, I'm here in Ontario. I don't want to get too, Ontario centric. If you look at cities, especially in the prairies, and to a lesser extent in Atlantic Canada, they're not over frothy. They haven't seen the kind of wild gains that we've seen in southern Ontario and some other locations in the country. So I don't think there's necessarily going to be a reckoning in a lot of those centers, along the prairies, and even to some extent in BC. BC's been strong, but it hasn't been in the same, kind of frothy stratosphere that we've seen across much of southern Ontario. So this is not necessarily a national story that everyone's going to see a correction when interest rates do begin to rise meaningfully. I think that's mostly a story for the highest flyers in southern Ontario.
Okay, thanks, Doug. Let's go from real estate to taxes. So you briefly mentioned taxes as well in your presentation. I want your perspective. Like, how likely do you think that taxes are going to be increased by the government to reduce the budget deficit? And if you think so, then do you think that's the appropriate response by our government? And what do you think the long-term implication of a tax increase might be?
So first off, I totally do not think it's the right medicine for the economy. I mean, frankly, I think the best medicine or the best cure for the budget deficit that we've been running is a full and complete economic recovery. And anything that at all threatens or thwarts or can damage that recovery is counterproductive. And I include broad-based tax increases of any kind, whether it's income, corporate income, sales tax increases. I think that anything like that can thwart the recovery. And as I briefly mentioned in my presentation, the surprise I think to policymakers has been the extent to which revenues have recovered. If you look at recent months, government revenues are actually running above where they were before the pandemic began. That's certainly true at the provincial level. So, do we need a tax increase of any kind to really repair the damage? I don't believe so. Really, what stands out here is the level of spending that we've seen. Now, a lot of it was necessary spending to help support the economy through the lockdowns and restrictions. But as the economy reopens, most of that spending really is not required anymore and will naturally roll off, I would suggest, without any underlying damage to the economy, as as long as the economy is allowed to fully reopen again. So, I mentioned briefly that I think this is more of a political issue than an economic issue. And I stand by that. I think any kind of tax increase would almost be, I don't want to say for show, but it's almost like window dressing to be aimed at certain groups or industries that the government almost wants to show that they're taking a bit out of who may have done very relatively well during the pandemic. In terms of the likelihood of broad-based tax increases, I don't think it's very likely. One party that did not win the election has got a long laundry list of tax increases they'd like to see. But the ruling party didn't really have a lot of specific tax increases that they were suggesting. One thing was a luxury tax on vehicles and boats and planes above $100,000. I think that's going through. They also talked about a tax increase on some large digital companies as well. I suspect that might happen too. They also, I think, want to get a little bit tougher in terms of minimum tax rates on relatively wealthy individuals. But in terms of broad wealth taxes or an increase in marginal rates, first of all, I don't think that's wise, and I don't think it's likely either. The one fairly significant broad-based tax increase I would be looking at that I think is possible, I'm not saying it's probable, but I think it's possible, would be an increase in the capital gains inclusion rate. That's certainly one the NDP would be fully behind, and it's one I believe the government has looked at long and hard. Now, the only thing I would say is, the Liberals have been in power for 6 years. There have been rumors almost since the day they came in that the capital gains rate might go up, and it hasn't in 6 years. So I still don't rank it as probable, but possible, yes.
Okay, thanks, Doug. I think that was a great answer, by the way. I think it was crisp and clear, and I couldn't agree with you more. And I hope you're 100% right in what you just said there. Okay, let's go from taxes to trade. We know that trade has, of course, been highly impacted over at least the last 12 months or so. So, what do you think are the short and long term outlooks when you think about trade?
So in many respects, the short-term outlook really goes back to the whole supply chain issue. To what extent it continues to throw sand in the gears. And there I'm not talking about the really high visibility things we've had. For instance, the horrible news out of BC in recent days and weeks on the flooding that actually shut off highways and railways. For a short period of time, or the blockage of the Suez Canal earlier this year, or the containers that were lost off the coast of BC about a month ago or so. Those are high profile items, but from a very big picture, they're really of secondary importance in terms of impacting the supply chain. The much bigger issue has been the shortage of chips and the extent to which that's really crippled the auto industry. And keep in mind, the auto industry doesn't get a whole lot of play when we talk about trade anymore, but it's still one of our most important exports and imports. And we've actually seen about a 20% decline in auto production this year, even amid a pretty strong recovery in North America. We've had a 20% decline in auto production this year because of the chip shortage. Um, so, to the extent that these types of supply chain issues are resolved over the next year, I would suggest that the short-term outlook is actually better for trade over the next year, as industries slowly get back to normal in things like the auto sector, and hopefully we won't have some of these one-off supply disruptions, high visibility supply disruptions that we've had in the past year or so. And I still, as I mentioned, I still believe that the U.S. economy, the global economy, will see above average growth next year. So that's relatively positive. Looking a little bit longer out, well, we'll have to see first of all, what the outcome ultimately of the pandemic is. I'm a little bit more concerned about the longer term outlook for trade. Um, I am a bit discouraged about the protectionist leanings of the Biden administration. Definitely a friendlier, more straightforward face than the prior administration. But on the ground for Canadian exporters, some of the steps that the Biden administration has taken have been, quite harmful or potentially harmful for Canadian trade, whether it's Buy America or, the EV tax credit that they're talking about that would only go to American producers, American-based producers. These are potentially very harmful for Canadian trade. I'm also worried about the competitiveness of the Canadian economy. I don't think today's exchange rate is particularly harmful to Canada, but looking back to just before the pandemic began, we were steadily losing market share in many industries, and meanwhile we were also dealing with a full-on trade battle between the U.S. and China. If we cast our minds back to pre-pandemic days, that was the single biggest issue over financial markets before the pandemic was the trade battle between the U.S. and China. And that has not gone away. That's one area where the Democrats and the Republicans in Washington, there's actually a lot of bipartisan agreement in terms of how to deal with China. And so, I think that kind of friction will probably resume. Not that it really ever went away, but it will resume as a pretty big issue for financial markets and the trade outlook as we get on the other side of this. And frankly, I do think there is the potential for Canada to be caught in the crossfire of that trade battle when we emerge on the other side of this. And I don't want to end on a negative note. I think there's still lots of big opportunities for Canada out there. The agricultural space is one I think we have tremendous long-term potential on, for instance, and then there are many different manufacturing industries that I think can benefit. I talked about the pent-up demand, I think, on the auto side over the next couple of years. So I don't want to be downbeat. I think there are lots of opportunities for trade over the medium and longer term, but it's going to be a challenge in amid a world where we have these sort of frosty trade relations between the U.S. and China.
So sorry, just follow up on that then. From with what you just said, um, does that create opportunities? Are you in the camp of this will create opportunities to bring more manufacturing home again? Do you think? Like, are you in that camp?
To a small extent, yes, and that's an area that I think really does remain open for interpretation, and that's one where I don't think we've really settled the dust hasn't settled on yet. I know during the depths of the pandemic, a lot of people were talking about reshoring, and some of the supply chain issues we've seen in the past year have sort of reinforced the view we could see more reshoring of manufacturing production into North America. I think Mexico actually stands to really be a big beneficiary. There's just been news in recent days that Samsung is looking at building a massive chip plant in Texas, just as one example. So I think there actually are a lot of opportunities on that front. The only thing I would say is, ultimately, firms are in an incredibly competitive world. They've really got to watch their costs, and as much as we'd like to see reshoring, it's got to be economically feasible as well. I think some sectors it's almost going to be mandated, like for instance in medical supplies. But looking more broadly out, I think it's still an open question whether we're going to see a big reshoring wave. But I do think there are at least some grounds for optimism on that front over the next few years.
Okay, thanks, Doug. I see that we are running out of time, so I want to thank you, Doug. We appreciate you taking the time with us today, as always. We appreciate your transparency and your candor, and the fact that, for an economist, Doug, you have a great way of simplifying very complex economic issues into something we can all understand and relate to. So that's much appreciated. And I want to thank you to our audience for joining us today. As you all know, the Ignite Conference is one of the most impactful gatherings for the Ismaili business community, allowing us to come together in our commitment to furthering relationships and fostering insights. And BMO is honored to again be the title sponsor for the conference. As well, we're pleased to host this particular session, bringing forward economic insights for you to consider as you look ahead into 2022. And I hope you have found this valuable. And if you have any questions or would like to further the conversation, please visit the BMO booth where you can find contact information and how to reach a BMO banker, also BMO bankers with specific industry expertise. And there's other resources as well, such as articles and podcast links. So again, thank you for joining us and enjoy the rest of the conference. Have a great day.